This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Ty Andros. Ty is the president of TraderView, publisher of the TEDbits website, and writer and editor of his well-recognized newsletter, also named TEDbits. Good morning, Ty. Welcome back to Macro Analytics.
Thank you for having me.
Ty, I want to discuss this morning the concepts of mispricing and malinvestment and the degree to which they have been taken to in the global financial markets. I have up a graphic I've been laying out to my subscribers and discussing on other macro analytics shows with John Rubino and Charles Hugh Smith specifically, that spells out the roadmap that leads to these concepts. I thought we'd start this morning, before we get into some of the troubling examples so evident all around us today, by how you define malinvestment and then how you define mispricing. Because I know you have some very strong feelings on the magnitude of this crisis.
Well, Gord, it's the basis of the crisis. It's the boom before the bust. It's when leverage fails. It's too many dollars and too much credit chasing too few opportunities that actually yield something. And as those pieces of paper try to chase a yield, everything that would normally be a regular investment that should yield some amount over inflation becomes something that actually turns into an investment that not only doesn't yield enough to preserve the purchasing power of what you put into it, it actually subtracts it and sends it to the state. And Bernanke's been keeping interest rates at zero for years and printing copious amounts of money, and he's really turned what wasn't a bubble. Now everything's a bubble. Can't think of one thing out there. I can think of two things out there that aren't malinvestments or mispriced. And one of them is gold and silver. And of course they've been manipulated downward to kill the canaries in the gold mine. And the other one is that's not mispriced is one you came up with, and that's Chinese labor.
Yeah, that's the only one that I feel comfortable with, Ty, is the labor rate of the Chinese worker today. And I'll extend that into most of Southeast Asia. But after that, I'm hard-pressed to find anything that's correctly priced. And a big driver of the mispricing right off the bat is the price that's denominated, and that's the currency and relative currency pegs.
Well, currencies have no meaning. There is no measure or unit of value like they had when gold and silver were behind them. So it's all, I'll call it a discretionary judgment call. Of course, these things are just going to accelerate because of the insolvencies in the system and the necessary money printing to try to rescue the elites and the banking systems and the people that control the system.
And once currency no longer is a store of value, and clearly it is not, and that usually comes with a fiat currency, which we're now clearly part of. And once you can no longer, a currency itself is not a store of value, it leads and accelerates malinvestment. Certainly mispricing. And once you have mispricing, you will have malinvestment. And that's one of the key drivers here. And as you were alluding to, Ty, when you start to have extended periods of low interest rates, you get unintended consequences, and you get many distortions, which then in turn leads to mispricing and malinvestments. And we're going to, in the next session, we're actually going to give our listeners some very specific examples of that. Do you want to define mispricing, Ty?
When mispricing is when you're in some kind of an investment, doesn't matter whether it's stocks or bonds or real estate, or well, it doesn't matter what you're in. If it doesn't yield more than the rate of inflation, and then an additional return to reflect the risk of the asset class, then it's mispriced. And, we now see, junk bonds at historic lows. We see real estate that really can't deliver more return than it costs for you to pay the mortgage. You have stocks yielding under 2%. You have government bonds yielding under 2%. Those are, highly correlated instruments now, because the correlation is all in the money printing. And we are going to, at some point, leverage is going to fail. There isn't going to be someone that can borrow enough money to become the Ponzi man, to take it off at a higher price. But the big tragedy, Gord, is that the whole world, whether it be the banks or individual investors, are all in the same trade. And as you well know, Gord, those things, when you're that correlated, how many people are really going to survive I'll call it the market clearing event, when these things actually have to return to reality. We were talking before the session, Gord, and talking about people can't find any yield on anything. Well, it's worse than that, isn't it? It's actually, they can't find any yield, but on top of that, they're losing purchasing power at 7 to 9% a year.
I found past weekend talking to so many people in various events that we were at, is that people that own businesses that are selling them, people that are self-financed their own retirements, can't get the yield to support the standard of living that they were planning on. And if they can find the yield, and there's a few of them who think they will quickly acknowledge the risk that goes with it is something they before were never prepared to accept. It's causing all sorts of major issues and behavioral shifts that people are very nervous about. It goes without saying.
Well, they really removed any kind of refuge out there. There is no refuge. And they're going to continue to do so. As you well know, these people are morally and fiscally insolvent. And who are these people? These people are the elite bankers and Wall Street and morally and fiscally bankrupt public servants out of Washington and in state houses. These people have painted the economies into a corner that there's no escape from.
They've done it through a number of different ways, Ty, and you and I had a large discussion. We talked about how we have false growth today, and how we dramatically and distorted the GDP growth. That it's in fact we're not seeing real growth. So where you get is companies and people that have expectations that we're in growth, when in fact we don't have any growth. You plan a business and you don't see the growth, and that's why no new business is not expanding. They don't see the growth right now. And so what happens is you've got this lack of growth, but it also we got the distortions that I showed in that first chart that came from the government, for example, interest rates, and I'm showing that here right now. The magnitude of the distortions on interest rates, and we think are inflation, I meant to say, versus the interest rates that you can get. And this is showing John Williams's where he believes we're north of 10% of inflation if measured the way we used to measure it in 1980 based. So because we've distorted it, with the inflation is much higher. And that's why people are making the comments that I just mentioned, because without them understanding that, they know that they're just not getting ahead. They're falling behind, and they can't find investments that are real, that'll protect themselves, that are not in fact losing ground.
Well, just look at this chart here. If you look at the left-hand side of it, going back to 1982, this would argue that 30-year bonds should be trading at about a 14% yield.
Precisely.
3% above that 10.
They were actually around 15% at that time.
Well, but you remember, we have to price in our return for the risk. And of course, bonds are the riskiest of everything. Government bonds, there's no way that money's going to be repaid except through a printing press. It's the greatest illusion, and it'll be the greatest catastrophe of all time when these illusions fail.
Ty, one of the ways I look at this is this chart I have up now, and this is looking at in inflation. Now, this is coming from the Bureau of Labor Statistics, and I don't believe their statistics, but I'm just going to accept this. And as they were reported, and then they've been changed clearly since 1972, 1980, we started to begin to massage them, and then started to really accelerate our massaging of the data through the 90s right up through now. And what you can see is, for whatever reason, the reporting of the inflation has been steadily narrowing down. And as we're getting, let's say, we're becoming more stable, or at least our reporting of these anomalies would suggest from this particular chart. And I believe if we took John Williams's numbers and you overlaid onto it, you can see we're just about, we've almost massaged and distorted it about as far as we go before it breaks loose. And I can see that we're just on the verge of breaking through this trend line, and I'm not sure we can hide it much more, and it's ready to go. Comments on that chart?
Well, Gord, I think you've got that trend line a little bit too high. Although we can see 2 points, but I would argue that we are through that. If we're not, we're right there about to break out. And as you can see from that previous chart, those technical patterns work on everything. And you can see that coiling there, it's going to be like a spring coming out of there, like a steel spring. And of course, we're sitting there living in the land of lies, or George Orwell's 1984, but we're busting up right against that top trend line. And, that's a continuation pattern there, if I'm not mistaken, and a symmetrical flag. And once we go through there, Gord, we can really expect it to go travel the distance from the highest to the lowest, right? So we're actually staring, 20 to 30% inflation in the face when this pattern becomes active.
Ty, and the chart I'm showing right now, to just echo your point, look at what's happening with food in China. And I'm just picking on China. That's 10% compound average growth rate. Where food is a dominant percentage of people's disposable income. And this is just representative of what real inflation is. That's all I'm trying to point out. And the MIT's $1 billion price project shows the same sort of thing. So it's there. It's coiling. And as you correctly point out, it's ready to go. It's ready to burst. And we're already seeing the beginnings of it around the world.
Well, you can really see the trends in place there with your Chinese chart. And you can see the trends in place if you look at John Williams and that sort of thing. These are trends that are, been in place for 10 years or more. And they're stubborn things. And to think that we're going to see any kind of a restraint in money printing, I think, is wishful thinking.
We're going to see an acceleration from the already fast pace that we're going at. There's almost no question about that.
Well, people think that the money printing is to goose the economy, and I guess it does ultimately when the government spends the dough. But really, quantitative easing, Gord, is not for stimulating economies, but covering up government insolvency, isn't it?
That's one way of looking at it. I would argue maybe a correct way, because that is what's going on. I mean, that's what the whole essence of financial repression, which is one of the things you've been talking about when you get high risk for low yield, is in fact to allow transfer of wealth, because as I said, money's not a store of wealth. So you're transferring wealth from those who have it in the public private sector into the public sector to pay the debt. And you're paying it off with less valued currency. So it's effectively a wealth transfer.
Transfer scheme. It's been in place for 100 years. It's not going to change anytime soon until after the final denouement.
And the way you see this is that your standard, the most blatant thing is if you think your standard of living is falling, then in fact there's the proof. And it may not be happening to you as an individual here as a listener, but the whole middle class is being totally gutted right now. The upper middle class is under siege. That's an example that your standard of living is being beat down, and that's effectively this wealth transfer that I'm talking about, which is a core of a macroprudential strategy called financial repression. It's being practiced to be able to pay the debt of over-debted sovereigns. It's not unique to the United States.
And we really haven't seen them try to inflate themselves away, and we expect that to happen, don't we, Gord?
Exactly. They've been doing it. Balance sheets of central banks have been growing very, very rapidly. We're nowhere near what it's going to be or what's coming. They have no choice. We put ourselves onto a path where they'll have to do it. And I believe we'll see it accelerate this fall and early into January, when they'll be firing big bazookas and it'll be globally coordinated. We've got so much deleveraging that must happen. And deleveraging, the best way of saying it, mispricing and malinvestment. And the malinvestment, we have non-performing loans so broad-based now. You can cover it up on the books for only a period of time until the non-performing loans don't generate enough cash that they show that the underlying assets are not what they're on the books claiming to be. And therefore, when the rollovers happen with debt, which are happening with all of this, how are you going to roll it over at inflated price? You can do that occasionally, but you can't do it to the degree we're now at. And there's the wall we're hitting.
But they're trying to do it systematically.
They have been,
and they're going to try to do it going forward, because anything else is a collapse of the system.
But they're trying to. The issue is that the collateral is no longer. They know is no longer supporting the debt that's with it, and so people are taking down the collateral values. Maybe not on the books, but when they have to fund it, somebody's saying, "I don't believe it's worth that. I'm not giving you that amount of money for it."
Well, but Gord, we can do a little simple math, and there's 60 billion or 50 billion of real assets, and I'll call that homes, manufacturing, real estate. But then we have $200 trillion worth of debt. So we've got 80 or 90 trillion that literally has no collateral.
Well, there's 150 trillion of debt, and there's, as you say, 50 trillion of other assets for total worldwide of approximately 200 trillion right now.
So if you collateralize the 50 trillion,
supporting underlying 150 trillion worth of debt.
And, somebody's not going to have a seat on the Titanic when it comes time to take possession of the underlying assets.
Yeah, especially when those underlying assets are non-performing and have to be written down. And you can see the leverage that's already there. It's about a $30 trillion problem.
For now.
Right now. That's what it is.
I mean, do you really expect it to stop here? We haven't seen any real deleveraging at all, have we?
That would suggest that the total global debt needs to be moved down somewhere from about 150 down into about 120 trillion. That's over the next 3 to 6 years. That's the roadmap that effectively the banks are going to try and glide us in on, and they're going to have a bear of a time doing it.
Yeah, but at some point somebody's got to start borrowing again, and once that decline starts, how do you do that falling knife trade?
Yeah, how do you? But Ty, what do you post as collateral when you want to borrow? If you've got a business the things aren't growing because it's not generating cash, or you've got assets that are non-performing,
you've got to have somebody that's going to step up and buy those non-performing assets at some price, and I believe that
that'll come.
It will come, but
see, that's what's happening, Ty, right now. Is the smart money, the really smart money, is hunkering down because they want to have value in assets that will allow them to secure these other assets that are non-performing now at a price that will in fact make them performing assets. Think of it this way. They want to buy real estates at 20 cents on the dollar.
And they'll get it.
And when they can get it, all of a sudden, even if the occupancy is 60% in a slow-moving economy, now you got a performing asset. So this is a whole releveling of pricing.
But once you strip the debt out, you can become instantly take it to a market clearing price and fill it up.
Exactly. Same with sovereign debt. If you could clear the debt out, you can make some of these countries perform. The problem is nobody right now. We don't want to form bankruptcies. We don't want to take write-offs because the bond or the banks and the bondholders have got more power over the political apparatus and the regulators that should be forcing this to happen. You can only kick this can so long before balance sheets just totally disintegrate on you. And that's effectively what we're doing. We're buying time until this miracle growth happens, which won't happen, or these balance, and it's going to be more expensive, Ty, when this happens. The best time to cut is to cut hard, cut fast, cut soon, and preserve cash so that you'll be all right. And if you let it go on too long, you're in worse shape. You have to cut deeper and further. And that's the damage that we're in now.
I would argue that they needed to do it in the 2000 and 2001 level. They needed to let it all clear out. They didn't. they didn't in any way, shape, or form. And that what would have been a roadside bomb incident has now become a nuclear bomb.
Right. I would agree with that, Ty. The tech bubble explosion, which shows in the real market, which started in December of 1999, not the spring of 2000, but was during that period and when we started the reflation that we shouldn't have. That's when we should have taken the write-downs, forced the bankruptcies, stopped the magnitude of securitization. We would have had a shot at it, but we didn't. We took the easy way out. We papered it over. Now the problem is so massive.
They missed their opportunity, they missed the turn in the road, and now it's a catastrophe.
Now, you have two last charts as we wrap this session. I have one of them up here on gold.
Well, one of them is just repricing gold for the amount of money printing that's taken place since the global financial crisis started, and it's courtesy of QBAMCO, who does excellent work. Although I expect it to go to actually quite a multiple of this. It's talking about $10,000 gold. I think that when people actually come off the sidelines, it'll massively overshoot because there's, British pounds chasing the gold and all sorts of, I'll call it counterfeit money out there that is going to look to become real money. And then the next one just shows you the depths of I'll call it rape that the United States government is taking people that are supposedly holding risk-free securities. And, of course, it shows the pricing of a 10-year Treasury yield if it was deflated by CPI or by shadow stats. And in each case, you are losing money on a compounded annual basis of as high as 9%. And do you really expect that to end anytime soon, Gord?
I think you know what I feel on that. We need to wrap right now. We're up against our hard line. Yeah, any final comments on this chart or anything we've said? Because we're going to be coming back with a second part of this session where we're going to talk about specific examples of mispricing and malinvestments. Any final comments?
No, other than everything is mispriced. Even if you don't owe anything on the assets that you hold, you're sitting in an over-leveraged investment, that the greatest buying opportunities are in front of us, not behind us. The search for yield is a search for death. This is just the final boom before the final bust, as von Mises puts it.
Ty, how would people learn more about your work and the solutions you have for these problems we're talking about? Because I know that this is your specialty, that you spend your time every day working on solutions to this problem.
Gord, I'm an absolute return alternative investment specialist, which is quite a mouthful, but it's basically what I do is I show people how to restore the functions of money to their paper dollars, because I don't believe you can make money after real inflation unless you do that first. And so I use gold and silver techniques to do that. And then what I do is I help them diversify their portfolio into managers that are very nimble and have no problem getting short a market or get long. But they're only in it for a trade. Their job is to find low-risk opportunities, put you in them in a heartbeat during that period, and then manage the risk. And they work on an incentive basis, because the devil is, how do you preserve your wealth and build it as this chaos unfolds? And the chaos is actually the greatest opportunity in history, properly approached, and, probably your demise if it's not.
Ty, how would people get a hold of you to find out more information specifically on this or to talk to you? How would they contact you?
They could go to my website, traderview.com, and fill out a consultation request. Everybody talks to me personally. I have a $100,000 minimum account size. I'm a boutique, so you're not going to talk to somebody that's told what to think or told what to sell or told what to say. You're going to be getting a top-quality Austrian economist that has actually worked hard to create solutions and to the challenges that are going to be facing us now and in the future.
Ty, thank you very much. We're going to break now, but we're going to be back in our next session, and we're going to talk about specific examples of mispricing malinvestments. Talk to you later.
Thank you, Gord.
Talk to you later.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.